Okay, I think if we're live, then we can make a start. Well, good morning, everyone, and welcome to Field Fish's discussion group for corporate services providers. We have a truly international theme this time round, with speakers from across our European network. Marsley Hale, Simon Lafferty, Peter Nust and I will be discussing matters that we have seen from here in the London office. Yanis Erifilidis will be discussing the Greek market, amongst other things, from his office in Athens. Rudiger Litten, from our Frankfurt office, will be considering issues for corporate services providers in Germany, and Ingrid Depardieu will be reporting in from our Luxembourg office. Following on from our successful Structured Finance Forum in Dublin in March, Aaron McGarry from our Dublin office will be discussing the Irish market. Please do feel free to follow up with me or any of our speakers about topics we discuss after the webinar. We are all available as needed. Now, on to our first speaker, Marsley Hale and Sam Clines.
Good morning, everybody. My name's Marsley Hale. I am a structured finance partner in Alex's team. I think I know most of you on this list, but it's great to have the opportunity to speak to you this morning. We are going to talk about the discretionary commission arrangements in relation to motor finance. We understand, obviously, as SPVs or issuers, that you will not be responsible for dealing with this or fixing this problem, but we wanted to highlight what's happening and give you a chronology of what's happened to date, and to explain what the issue is, because in some structures, both past and present, there will be liability in relation to originators selling of motor finance between the periods of 2007 to 2021. And actually, it could be ongoing if people aren't doing what they were meant to do from 2021. So where you have clients or people talking about it, we just wanted to give you a little, at the moment, just a brief overview of what's happened, but also be available to you if you have any questions after. So I'm going to pass over to Sam, who's going to share with you a slide showing what's happened to date and to run through the issues. And then we will talk about any kind of potential opportunities for you to assist your clients in relation to this subject matter.
Thank you, Marsley. Nice to be here with you all today. I don't think I will have met too many of you, so just by way of introduction, I'm a senior associate and barrister in the financial regulatory team here at Field Fisher in London. And as Marsley says, we're going to give you a quick overview of the landscape as regards the current litigation in relation to discretionary commission arrangements and undisclosed commissions, initially in the motor finance space, but as we're going to discuss, it's actually got wider ramifications across the market. It's useful to sort of begin in 2021. So in January 2021, the FCA took steps to ban discretionary commission arrangements in the motor finance market. Now, these, for anyone that doesn't know, are arrangements whereby a lender pays a variable amount of commission to a broker, which is obviously usually a motor dealer, and the amount of the commission will vary based on the broker's ability to get borrowers to sign up to terms advantageous to the lender, i.e. by paying a higher interest rate on the vehicle finance. At the same time, the FCA also tweaked its rules on commission disclosure, which is you'll see why that's relevant momentarily. But the failure to disclose these arrangements properly to borrowers was one of the key drivers of unfairness that the FCA identified. After that, quite quickly, what happened was that consumers began to try and seek redress from lenders for the commission they'd previously paid. And two tracks developed. The first was consumers obviously complaining to lenders, being rebuffed, and then being sent to the Financial Ombudsman Service, which rapidly developed a pipeline and then a significant backlog in terms of its cases. The second track was through the courts, consumers suing lenders to try and reclaim commission. And one of the problems that emerged was that these two tracks were producing different results. the Financial Ombudsman Service was ruling in favour of claimants. And in general terms, the theme of these decisions was that the Financial Ombudsman Service felt that the commission arrangements were unfair because they hadn't been properly disclosed, and that they were in breach of the Consumer Credit Act 1974, and therefore that opened the lender up to remedy. The courts took a different view and were generally ruling very much in favour of the defendant lenders. And without taking you through the tortuous history, and to simplify it slightly, these two tracks essentially converged in a Court of Appeal case last year, which has gone on to become quite well known because there's been a lot of media commentary about it. That was the case of Johnson, Wrench and Hopcraft. And momentarily we'll consider the conclusions that the court came to, but in headline, the court essentially confirmed that lenders are very much exposed to potential liability in relation to the commission arrangements between themselves and brokers. And in fact, it goes further because the court's judgment is not in any way confined to discretionary commission arrangements of the type banned by the FCA. And in fact, is not even confined to motor finance in terms of the principles. And that's why the recent Supreme Court case, which was the appeal from that case, which was heard in early April, is going to be absolutely critical in determining what happens next. It is useful just to think about what the Court of Appeal decided. So, as I say, it didn't really bother too much about the distinction between discretionary commission arrangements or motor finance. It separated commissions into two broad categories: secret commissions and half-secret commissions. So a secret commission is exactly what it sounds like. It's a commission paid by a lender to a broker, which is not in any way disclosed to the borrower. And the Court of Appeal held that for tortious purposes, that's a bribe. It's classified as contravening the tort of bribery, and therefore the lender is liable to the borrower for redress, some form of equitable compensation. That isn't especially controversial in terms of kind of long-standing principles. But what was a bit more controversial is that the court extended the definition of what it means to be a fully secret commission. So the court said, well, if the commission is buried deep in the small print where no one can find it, but is otherwise disclosed, that could still be a fully secret case. That potentially greatly widens the ambit of fully secret cases. In terms of half-secret cases, which is where the commission is de facto the commission is disclosed, but key facts about it are missing. The court held that brokers have a duty to borrowers to get them the best deal. Particularly, this was in the motor finance context, but again, could be applied more widely. If a broker fails to disclose fully the commission arrangements, they've breached that duty. And if the lender has paid the commission to the broker, knowing that the broker isn't going to disclose it, the lender can be said to have procured that breach and therefore is liable as an accessory. Now, this is the thing that's proved most controversial about the judgment because of the way it potentially widens the scope and impact of it. And there's lots of academic commentary and all sorts of back and forth, but we've actually said you need to look past that and look at the other part of the judgment, which also found, just as the Financial Ombudsman Service did, that these half-secret commission arrangements were unfair, comprised an unfair relationship for the purposes of the Consumer Credit Act. So actually, there's a significant chance that won't be overturned, and that there will be quite a wide-ranging liability following the judgment. So as I say, the Supreme Court is considering the matter. Its judgment will come out in July, and the potential implications are very wide-ranging. So the FCA is considering whether to introduce a market-wide consumer redress scheme, and it's explicitly waiting on the outcome of the judgment to determine whether and how it will do that and what the parameters will be. And then also circling like sharks in the water are claimant law firms and CMCs who are waiting to see whether they will be able to pursue claims through the redress scheme and or through the courts, not just in the motor finance space, but much more widely. Implications particularly relevant to this group. Well, we observed during similar events in the past, in particular the diesel emissions scandal, that claimant law firms like to throw around as much mud as possible, not just at lenders, but at companies in their group and also at entities within securitization structures, in order to try and cajole, browbeat those entities into some form of response, in some cases to try and get them to sign up to settlement agreements. Now, actually, those attempts are generally rather easily rebutted if you're well prepared. So if you're up to date with what your actual contractual positions are, what your indemnity position is, and you're ready to respond in short order to, in polite terms, tell these claimant firms to get lost, then actually entities within a securitization structure are in a good position. But it's really important to be prepared, because we found again during diesel emissions that entities that were being reactive were incurring a lot of costs, a lot of stress, a lot of effort when they didn't necessarily need to be. Marcely, is there anything that you'd like to add to all that whistle-stop tour?
The only thing I would add is that if clients are coming to you with any kind of correspondence or queries about passive structures where loans have been, redeemed, it's all kind of closed or it's ongoing. If they are coming to you, there are people offering, from the servicing community, a managed service for this. So they could take the problem away, I suppose. Obviously, that there's a cost implication, but there are the big four and other services offering to help captives, broker dealers, all the supply chain really, in getting ready for what's coming and then taking the redress scheme from the FCA or whatever's prescribed through from an operational perspective. So there may just be people that aren't very, well set up from an employee perspective, from a knowledge and understanding perspective, and ultimately this might be quite a tech play. But there are people available and offering their services. There are some webinars coming up just on this particular topic, and as soon as I'll let Sam tell you what's going to happen next, or what, well, he doesn't know what's going to happen next, but the timelines for the kind of resolution that the FCA are hoping to provide. So once we know what's happening and it's a prescribed route, there will be people in the servicing community that can do that for various stakeholders within the structures. Sam, do you just want to touch on timing for?
Yeah, of course. So the Supreme Court judgment is due to come out in July, but there's a chance it may slip to September. The FCA has sort of committed to issuing some form of response indicating its direction of travel within 6 weeks of that time frame. Then one would imagine that they definitely would need to consult, which is a minimum 3-month process. So I think by the time we get towards Q3, Q4, we'll have a much clearer idea of the lay of the land. And then assuming that some form of redress exercise begins, operationally, it would be hard to imagine that coming on stream before the middle of next year. But none of that would necessarily preclude law firms, if they wanted to pursue litigation through the courts, they're not bound by the same timetable. So there's 2 parallel tracks that we need to make sure we're always aware of.
Thank you, Sam.
That's great. Thank you, Marcely. Thank you, Sam. Moving on to me as the next speaker, Recent Matters Pipeline Issues London. I wanted to talk about lifetime mortgage securitizations. For those of you that don't know, a lifetime mortgage is an equity release product. It is a loan secured against a homeowner's property that allows them to access tax-free cash from the equity in their property while still being able to live in it. The UK lifetime mortgage market has seen significant growth over the past decade due to an ageing population, increased life expectancy, and a greater need for financial flexibility in retirement. Advising on financial transactions involving lifetime mortgages and similar products now represents a big area of practice for Field Fisher's structured finance team. We advise loan originators, loan servicers, corporate services providers, and corporate trustees in the sector and we're becoming leading experts in the legal market. We're also looking at them in the context of pension fund investments and long-dated swap arrangements. Lifetime mortgages are becoming a popular asset class to securitize. Recent originators that have securitized their books include Aviva, Live More, Citi, One Family, Lloyds, More to Life, and Foundation Home Loans. A few things to note. The loans are usually repaid in one go on the passing of the homeowner and from the sale proceeds of the property. Portfolio redemptions can therefore be a bit lumpy. There's also a risk of negative equity and property value at the point of sale. Also consider issues around insurance policies, mortgage prisoners, consumer duty regulations, and changes in originator business strategies. We're currently advising an originator on the sale of his lifetime mortgages business. We're advising on the legal title transfer and the servicing arrangements of the loan portfolios to a third-party purchaser, as well as employment law arrangements regarding the winding up of the business. One of the loan portfolios has been securitized, so we've been drafting the documents for the restructuring of the securitization. The problem with the transaction documents is that they assumed that whilst the beneficial title to the loan portfolio might move, the legal title would always stay with the originator unless there was, for an example, a Lehman-style insolvency. It's therefore been necessary to obtain noteholder consent to modify the documents and implement the transfers. Field Fisher would recommend that legal title transfers at the option of the originator for business reasons to a suitably qualified legal title holder and servicer should be a feature that is built into future transactions of a similar nature. We're also advising on a couple of interesting legacy RMBS securitizations where clean-up call thresholds have been met. Under the terms of the transaction documents, once the aggregate principal amount outstanding of the notes is less than or equal to 10% of the initial amount outstanding on the issue date, the trustee shall instruct the issuer to conduct an auction process. The servicer shall invite bids from at least 3 potential purchasers of the mortgage pool. In the event that at least one of the bids is sufficient to redeem the notes in full, together with accrued interest, then the highest bidder will be selected to purchase the mortgage pool from the issuer. The full amount of the offer must also include the costs of the transaction parties to redeem the transaction. From an issuer perspective, the points to be aware of when a clean-up call threshold has been met are the following. That the clean-up call threshold has actually been met. This should be determinable from the most recent investor report, supported by a statement from the cash manager. That the winning bid is sufficient to fully redeem the notes and cover the cost of the redemption so that the issuer is made whole and not left short. And also that the timings of the redemption work effectively. From an issuer perspective, the notes will need to be redeemed on a certain interest payment date, but the purchaser may also have to look at back-to-back warehouse or securitization funding needs and those related timings, and will also need to take those into account. One issue that seems to be affecting many of the older securitizations in the market relates to the cost of servicing loan portfolios and the ability for servicers to increase their fees under terms of the documents. We're advising a number of securitizations at the moment where the fee rates for servicers were set over 15 years ago. In some cases, the documents do not contemplate that the fees will increase over time, taking into account increases in the retail price index, inflation, increased rates due to loan delinquencies over time, and increased obligations due to new consumer regulations. Where increases need to be documented through the modification of the servicing agreement, the issuer will be required to seek trustee consent. The trustee may be able to exercise its discretion to agree to the modification on the basis that it is not materially prejudicial to the interests of the note holders, but this will be in reliance on a director's certificate from the issuer and rating confirmations from rating agencies that confirm their note ratings will not be adversely affected. The problem comes where for higher delinquent loan portfolios, the service fee increase becomes substantial and rating confirmations are not available. The issuer may find itself in a difficult situation where trustee consent is not forthcoming and the issuer cannot consent to fee increases. The servicer cannot afford to continue servicing the portfolio as it would need to do so at a loss, but the servicer is also unable to resign unless a replacement servicer is appointed on the same commercial terms as the current servicer. In these circumstances, the issuer may need to look to consider seeking note holder direction to address the matter, notwithstanding the cost to the transaction for doing so. And finally, Field Fisher is a leading financial regulatory team headed up by Simon Lafferty, and you've heard from Sam just a little bit earlier. You already know that we are able to advise corporate service providers on, for example, the impact of new regulations on the financial transactions that you're responsible for, or the impact on corporate service provider businesses themselves. We can also advise the clients of corporate services providers on their regulatory needs. We're currently helping a CSP client to obtain an authorized payment institution license so that they can offer a range of regulated payment services, including money remittance, payment processing, and account management. Once the FCA license has been obtained, the CSP can help the client expand their business in the UK. It's an excellent example of how Field Fisher can collaborate with you effectively to service your clients' needs and grow your own business. That's all from me. So I'm now going to hand over to Peter.
Thanks, Alex. So on the slide there, I'm just going to race through 4 topics that are current live issues that I've been considering. First of all, restructuring of private securitizations. There are a number of both formal and informal restructurings going on at the moment, including many for the issuers, including on a restructuring plan at the obligor level of a securitization transaction. These restructuring plans, these are court-approved plans which bind the relevant creditors, if approved, including the issuer. Note holders would expect to vote as the controlling creditors, as per schemes of arrangement, but this particular restructuring plan acknowledged the uncertainty here as to whether it was the issuer, the trustee, or the note holders who are the correct people to vote. This was a particular concern here, where it was a contested restructuring plan, where the note holders were not sure whether they would vote in favour or against the plan. There was a concern, therefore, that the obligors may seek to exclude the note holders' negative vote on the basis that the issuer was the correct creditor and did not themselves vote. The note holders therefore sought our assurance that the issuer would issue a letter to the court confirming that it would have voted in the same way as the note holders did. As I say, the issuer will be bound by the restructuring plan if it is approved. This can have consequences for the issuer, including a further assurance clause within the documents, and also a restructuring of the relevant debts which were owed to the issuer. This restructuring can bypass the issuer, paying money directly to note holders, which clearly can have real consequences for the issuer's financial position. Now to look to DAMLs, DAMLs. This is a different defaulted private securitization. The originator collapsed recently due to concerns about the identity of the underlying borrowers that had been financed, which may have been fraudulent. The parties sought to use and disperse funds from the relevant bank accounts. There was therefore a concern that those monies in the accounts may have come from or be used in respect of these criminal activities. Where there was a suspicion that property you intend to deal with is in some way criminal, and that by dealing with it, you risk committing one of the principal money laundering offences on the Proceeds of Crime Act, you may seek a defence against money laundering, or a DAML, from the National Crime Agency. The Court of Appeal defines suspicion of money laundering as a possibility which is more than fanciful. The other person was or had been engaged in or benefited from criminal conduct, and that suspicion formed was of a settled nature. There does not need to be anything amounting to evidence of the suspected money laundering. the threshold for suspicion under the Proceeds of Crime Act is therefore considered to be low. It's therefore important, if there is any suspicion, that you seek relevant advice and a DAML from the National Crime Agency in these circumstances. As I said, they should be fairly short receipt. I think there's a statutory period where they have to respond, and we received ours in fairly short order. On another matter, which we have looked at recently, there was a purported default by an agent. So in that case, it was on a securitization transaction where the agent of the issuer had made a mistake, or purportedly to make a mistake. In that issue, it was a question as to who had suffered the loss. In the current circumstances, it appeared to be the subordinated note holder who was driving the process and who would be the entity who would have suffered the loss as a result of this potential breach. I think it's worth a refresher, as per the Collier's case from many years ago, where that an issuer can sue for its own loss. In that Collier's case, a CMBS issuer claimed against a valuer for negligent valuation of the property that had been acquired. In that way, there may be an alignment of the issuer position with the underlying note holders. However, the issuer will need to be mindful of its obligations under transaction documents as regards how any recoveries are dispersed. There may not be, as I say, a conflict as regards the claim, but once the monies are held by the issuer, it will need to know and determine how those are dispersed, which may cause a conflict with how the note holder considers they should be dispersed. And finally, ECTA. We touched on ECTA on previous CSP events, but the work on it continues. Just to summarize what this means, at the end of 2023, the widening of corporate liability was brought in by ECTA, changing a position where the directors needs to be responsible to rather managing supervisors were therefore responsible and would have caused the liability of the company. A real concern at the moment is identity verification, which again was brought in by ECTA, but is due to come into force later on this year. This really changes how companies interact with Companies House, and is a big change from how matters have happened in the past. Whenever you send something into Companies House, you need to have an identification process having been completed. Similarly, there's also the failure to prevent fraud offence, which is due to come into force on the 1st of September 2025. We were recently part of a panel at the Chartered Governance Institute event last month regarding identity verification, and there was a huge number of questions about the process that will have to be run amongst the huge group of company secretaries who are there. So although this is not strictly a securitization issuer question, clearly many of you will be directors or be part of that process, therefore will need to get your head round and therefore comply with these new rules on that side. Thank you, Alex.
Thank you, Peter. And now I'm going to hand over to Yannis Arifilidis.
Thank you, Alex. Good morning. Good morning from Athens. Establishing new float amounts for securitization transaction accounts. We have recently worked on certain legacy securitization transactions that were established around 20 years ago. Back then, there was no contractual provision for the establishment of a float amount in the relevant accounts for the payment of ongoing transaction expenses by the servicers. In more recent transactions, of course, there are always such provisions that enable the servicers to pay for expenses, the payment of which is vital for the preservation of the value of the underlying assets. Therefore, we are now asking the trustees to exercise their discretion to consent to the amendment of the relevant underlying documents in order to allow the establishment of float amounts on the basis that the relevant amendments are not just not materially prejudicial to the interests of the note holders, but in fact, they are beneficial to their interests. A relevant rating agency confirmation is also provided to the trustees, which gives them enough comfort and enable them to exercise their discretion. Replacing standby servicers with standby servicer facilitators in securitization transactions. We are currently working on certain transactions where the standby servicers have resigned because they ceased to operate in the standby servicing market. What is interesting is that in those transactions, the standby servicer is being replaced by a standby servicer facilitator rather than a substitute standby servicer. Of course, the proposal has to be presented to the trustees, as we do not seek note holder consent for this exercise, and we are requesting the trustees to exercise their discretion and approve the deviation from the underlying document's contractual arrangements. The trustees are requested to waive the breach of the requirement that the appointment of a substitute standby servicer is made on the terms that the substitute standby servicer execute a standby servicing agreement substantially in the form of the current standby servicing agreement, and consent to the required amendments to the underlying documents. In principle, the trustees are okay to look into these requests, but they need to be clear on what basis the appointment of a standby servicer facilitator is equally as effective as or better than the appointment of a replacement standby servicer, as the relevant entity would purely act as a facilitator and not perform the role of the replacement servicer itself, as previous standby servicers would have done. The trustees need comfort around this point and why such proposal would not be materially prejudicial to the interests of the note holders. Apart from the analysis of the issuers in the relevant trustee consent letters, the trustees are provided with rating agency confirmations, which provide additional comfort and enable them to exercise their discretion and approve the appointment of standby servicer facilitators in place of standby servicers. Aircraft loan financing market. Over the years, we have advised on a diverse portfolio of aircraft finance transactions. We continue to advise on such transactions, especially trustees with a big share in the aircraft finance sector. And we have recently advised trustees in relation to the repayment of certain loans and release of security over the relevant aircraft and engines. These are straightforward transactions, as the trustees are always acting on the instruction of the national or facility agent. Nevertheless, the review can be time-consuming due to the volume of documents required and the variety of jurisdictions involved. And finally, Greek finance market. We continue to represent all four systemic Greek banks: Alpha Bank, Eurobank, National Bank of Greece, and Piraeus Bank, and also Greek companies that are active in the renewable energy sector, mainly wind and solar power. There is an increasing activity in the project finance sector in Greece. The structure used is that of a Greek law bond program that's used mainly for tax reasons. And we advise in all English law aspects of the transactions. We offer advice through our Greek desk in London, but we are also present in Greece. And we work with virtually all the big Greek law firms. If you need any further insight or advice on the Greek market, we're more than happy to help, and we're also able to facilitate any introductions you may need. Please do get in touch. Thank you very much.
Thank you, Yanis. And now we're moving over to Frankfurt and Rudiger Litten.
Thank you very much, Alex. Lots of activities in the German finance market. Business for CSPs and trustees has been on the rise in Frankfurt for a number of years and will continue to do so with lots of outsourcing activities going on by the banks and investment firms. There is more traditional securitization transactions, mostly in the automotive sector, but also all kinds of other structured transactions involving leasing and other forms of legal structuring. I brought with me 4 legal topics that I come across on a regular basis in my legal practice, and that may be of interest to you. Let me start with the one that's closest to my heart, and that's money, or more specifically, fees and expenses. Is the agent or the corporate services provider only obliged to act if he is sure to be compensated or even paid for in advance? That's a question that is sometimes asked under German law. What if the claim is against the SPV only and the SPV has no money? Are you supposed as an agent or trustee or corporate services provider to rely on the waterfall only? I've been in heated contract negotiations on that point, or post-contract negotiations. That's even worse. That's my advice is be vigilant here. That's a point that needs careful consideration in your contracts. Secondly, conflicts. If you find yourself in a situation where your firm acts both for the borrower, for example, corporate services provider, director for the SPV, and the lender, for example, a security trustee, then you may be in trouble. At least what you should do is to have very high and thick Chinese walls within your organization. That is something that is sometimes looked over, but needs careful legal consideration. Same topic number 3, personal liability of directors. I really relied on my lawyer and only found out later that he was a complete blockhead. That may be an excuse for a director that has a realistic sound to it, but it's not always sufficient to keep you as a director out of trouble. So it's very important that you as a director have a duty of care vis-a-vis the company you're working for, and also third-party creditors, and that may include the tax authorities. As a director, you must understand, at least in broad term, what's going on in your business, and you cannot just rely on the sponsor that gives you instructions or on other so-called experts. And my topic number 4 is licenses. Do you need, as a trustee or corporate services provider, a payment license for carrying out your business? Do you need what's a special German law license called the collection license for receivables? That means you are collecting payments for somebody else. For example, as a trustee, you need a license for that. And if you do, where do you get it from? Can you passport it from other European countries and so forth? My experience is you may get along without the license, doing your business properly, but certain types of services are then taboo for you. And if you provide them anyway, even unknowingly, you may be in trouble. So that is also something you should take into consideration. That's my 4 points. Alex, thank you. Back to you.
Thank you, Rudiger. And now we're going over to Luxembourg and to Ingrid de Paju.
Thank you, Alice. Good morning, everyone. Today, I wanted to touch bases on some topics which may not be new for some of you, but which are still of interest. We have seen recently a rise in the request of having some crowdfunding platform offering loans, and we discussed securitization in this respect. Top European policymakers such as ECB and Eurogroup mentioned that EU countries need massive private investments to advance the climate agenda and generate higher productivity and competitiveness. given the massive need of private investment to finance, banks are not able to fund them, and there is a further potential expansion for the securitization market as such. So the rise of the private financing through the SV is a significant development in EU and especially in Luxembourg, given the regulatory flexibility that we have. In the private financing, we have seen a shift of the securitization of a broader range of assets, and especially real estate recently, but also just loans, portfolio of loans to SMEs, which could be commercial loans, real estate, asset financing, whatever. There are several pitfalls that are to be considered when it comes to securitization of a portfolio of loans. So we would have SV originating loans. The question is whether this is possible, because technically or historically there should have been no new risk creation. So in principle, a securitization vehicle cannot go beyond its core purpose of risk transfer and should not originate new loans to third parties. Have been a new development in Luxembourg. I don't know for the other EU jurisdictions, but my colleagues may advise on that. Luxembourg has considered that NSV may directly originate loans lent to SMEs as part of the securitization, provided it is contemplated obviously in the securitization documents, and the funding comes from the securitization proceeds. The other pitfall is whether the portfolio of loans can be actively managed or not. And then it comes to the definition of what is the active management of a portfolio of loans. This is something we'll discuss after the webinar. Since 2022, the active management of securitized assets are allowed in certain private transactions, provided there is no publications of notes. This enabled Luxembourg vehicle to actively manage CLOs and CDO structures. For those who don't know, CLO is an actively managed securitized product backed by a highly diversified pool of leveraged loans. That would require actually DSV to manage the financial instruments, which is not the case in the situation that we have currently for a client. Again, the idea is just to originate loans, so to have a banking activity, except funding would come from private fundraising. So active management, what does it mean? It refers to a more dynamic management of the asset pool, akin to how an investment fund actually manager would operate a portfolio. It could be in a securitization vehicle, the portfolio manager could be the vehicle itself or an external manager, and it would have the authority to buy, sell, and substitute the assets on a discretionary basis, not on a passive basis as in the past. There is a point of attention, and there was a point of discussion, because for some market participants, the definition of a securitization under the Lux laws would still require that the risk would be those, the law still requires that risk are those assumed by third parties or inherent to the assets acquired, and that there should be no additional risks brought to the portfolio. Again, there have been some development here, because it is generally recognized that a portfolio composed of debt obligation, like security, financial debt instruments, whatever its form is, can be actively managed in Luxembourg. The other point of attention for most of our clients coming with that idea of having a sort of crowdfunding platform granting loans to SMEs is whether they need to be regulated under the EU regulation or whether they can just be subject to the Luxembourg law. So that's an important point of discussion, because obviously the structure under the EU regulation would require to be regulated under the regulation as soon as it involves tranching of credit risk. That is to be assessed on a case-by-case basis, depending upon the client structures, because obviously there could be different seniority and different risk appetites for the investors in the securitization vehicle. Okay, this is what I wanted to touch bases with you this morning, because this has been the point of attention, I would say, for the last quarter since 2025. We have been advising clients on these aspects, and there is a huge rise of interest for that kind of vehicle. Thank you.
Thank you, Ingrid. And now we're going over to Ireland, and I'm pleased to introduce you to Aaron McGarry.
Thanks, Alex. I'm really going to talk a little bit about some of the reforms that are going on at the EU level, which obviously affects everyone active in Ireland and obviously across the EU as well. And just to give you a bit of a background as to why this is going on and the reasons for this is really an issue around growth, especially across the EU, vis-a-vis some of the bigger markets in the world, such as the US and broadly China as well. So I think really the EU has kind of taken fright at some of the sort of graphs that we can see here, but not to go into any depth, but broadly just to sort of set out some of the numbers about how the disparity between the EU and the Eurozone and, say, America, so since 1999 and the birth of the Euro, the US economy was 11% larger than the Eurozone. It's now 30% larger. Nominal GDP in the Eurozone has stagnated, it has to be said, around 15 trillion euros. But in the US, this has grown 80% in that time to sort of 27 trillion euros. So quite a big increase. So, and in 2007, just before the global crisis, the average American had real income 27% higher than an average European, and it's now 35% larger. It's pretty worrying, and despite Donald's efforts to redress the balance, I think it's fair to say that even with his best efforts, some of those gaps are unfortunately heading in divergent ways in a way that makes the EU look even further behind. So there has been, therefore, a big think at the EU level with a view to coming up with some ideas about what are we going to do to change this. And it starts with Mario Draghi, who a lot of you will recognize as the ex-president of the ECB, and here he is with Ursula von der Leyen. And he produced a report last September on, the future of competitiveness. How does the EU manage to catch up with some of its global competitors? And this report has now been filtered down into what they have called the competitiveness compass, a bit of a mouthful. And it's taken Draghi's recommendations and it's kind of turning them into a program that can be delivered. And there's really three core areas of action. First is to close the innovation gap. And I think that's really a recognition that in truth, much of, say, the technology revolution that we're now living through has largely passed Europe by. Like most of the big tech companies tend to reside in the US or in the Far East. There needs to be an agreement across the EU about how we decarbonize and increase competitiveness at the same time. Certainly, I know some of the net zero targets have been re-looked at. And then thirdly, a look to reduce excessive dependencies and increase security. I mean, again, there's so many examples here, but we could say, the stopping relying on sort of Russian gas, the new view across Europe about increasing defense spending. How are we going to do that? How are we going to fund it? And then alongside this, then there are sort of 5 enablers identified to help achieve these goals. And really, I've set them out here, but probably the most relevant to us in our sort of working life and how that can impact us is the simplification. And the EU's Commission statement here is to reduce drastically the regulatory and administrative burden on companies operating in the EU with a view to making them more competitive and therefore to increase wealth generation, increase competitiveness across the EU so that we can compete more on a more level playing field with maybe some of our global competitors. So earlier this year, actually only a couple of months ago, the EU adopted what it called the Omnibus Package, and that is the start of this simplification process. And the aim here is to reduce the administrative burdens for all businesses across the EU by 25% for everyone, but 35% for SMEs. And this package amends this first package amends the Corporate Sustainability Reporting Directive and also the Corporate Sustainability Due Diligence Directive, both with the aim of making reporting on these directives much more efficient and less burdensome. Now, this is from the Commission. They believe it will remove around 80% of all companies from the Corporate Sustainability Reporting Directive, for example. It will ensure the sustainability reporting requirements won't then flow downwards down the value chain to small businesses, so placing an administrative burden on those companies, so relieving them of that. And it will also simplify the European sustainability reporting standards and limit the reporting to companies with 1,000 or more employees and 450 million euros in net turnover. On top of all of that, they're looking to delay the rollout of these directives by 2 years in order to allow these changes to be implemented. And so just to give you some figures, the Commission believes that these changes can ensure administrative costs will be saved to the tune of 4.4 billion euros. And so that's pretty significant, and is going down the road of maybe helping some of the businesses that we deal with and that you deal with less burdensome and less costly and less time consuming. But probably the biggest change that I think Europe and the EU is trying to engender is a reform to the EU securitization regulations. And there has been a concerted drive on this, and this comes from Draghi as well, but there is certainly a recognition at the EU level that there probably has to be an overhaul of these regulations, because there is a general feeling that these seem to have failed to engender the kind of securitization activity that it was hoped it would. So at the end of last year, there was a short consultation that was opened by the EU Commission to suggest reforms and how market players felt the regulations were working or not working. So to put this in some context, last year, EU debt issuance has reached 24 billion euros, and in the US, it was 1.4 trillion. So, you know, there is a sort of a big value divide there. And critics of the regulation would say sort of three things generally. First of all, the simple, transparent, standardized framework, which is in itself a reform, as we know, is probably a bit too restrictive. It excludes assets that are a little bit too difficult to standardize or seen as too difficult to standardize. Again, compare this with the US, and you have all sorts of assets go into securitization vehicles such as aviation loans, music royalties. The other big critic of it is that the capital charges imposed on securitization investments are too high compared to, say, bonds that carry the same risk on similar assets. And thirdly, the due diligence requirements are far more onerous than elsewhere in the world. So the EC is seeking input to reform all of these, plus other areas to simplify and maybe relax some of these regulations, because the upside is significant. And just to give you sort of one of the big market players like PIMCO has been on record suggesting that the EU regime actually in the securitization market really has broadly failed as an alternative credit channel to increase competitiveness and increase money into the broader economy. And solving it, it believes, can unlock something like 1 trillion euros in financing for wider EU economies. So food for thought there. I think it was just something well worth pointing out, and some of the changes coming down the track for us in terms of how we administer companies, the administrative burden across the EU for anyone with EU connections. And I think the goal here does seem to be one, certainly at the EU level, is to move away from perhaps being a trading block that is managing wealth to creating our own. Thanks so much, Alex.
Thank you. Well, thank you so much to all our speakers this morning. It was really interesting to hear from each of you, and certainly I'm planning to follow up with you on some of the things that were covered, and certainly for other attendees of this call, please do not hesitate to contact me or the other people on this call about any matter that you've heard about this morning that you think would be of interest and that you would like to discuss further. To round off, I wanted to give you some more dates for the diary. Field Fisher, as well as being very active in the corporate service provider space, is also active in the corporate trust space. As you know, we're members of the ICM SA, and they have their annual general meeting and forum on the 12th of May 2025, and there'll be a number of us attending, so that should be an interesting session. Peter Nuss and I will also be attending Global ABS in Barcelona, 10th to 12th of June. We're just sorting out our diaries at the moment. We'll certainly be in touch with you about getting meetings with you whilst we're over there. And I'm, as you know, Vice President of the Association of Corporate Trustees of TACT. And although we haven't yet announced this, you've got advance notice that the Loan Capital and Capital Markets Conference, the annual conference, will be held this year at Field Fisher, and that will be on the 3rd of September 2025. So that'll be a nice return to after your summer holidays. Our next corporate services provider discussion group will be taking place in London, and that will be a physical meeting this time. That will be on the 4th of November. And then on the 6th of November, we'll be holding our corporate services provider discussion group over in Frankfurt with Rudiger in our Frankfurt office. And that will be similar to what we've done over the years. I'm sure there'll be other dates to add to the diary and other events too. But in the meantime, that brings us to time now for this webinar, for this discussion group. And I wanted again to thank you and to thank all the speakers that spoke today, to Marcelly, to Sam, to Peter, to Yanis, to Rudiger, to Ingrid, and to Aaron. Thank you very much again.